folks. For chapter 8, this is the main focus of finance. That is, finance accounts for the risk very concretely, even and directly, and says that, well, for this amount of risk, what will you require as rate of return? So this chapter has given the first Nobel Prize for the finance discipline. So we will talk about standalone risk, and then portfolio risk, and the most importantly, we'll talk about a concrete relationship between risk and return through CAPM. CAPM is the equation, and SML is the graphical depiction of this equation. So we will talk about first standalone risk, and then we talk about portfolio risk. Standalone risk, like if you just buy a stock and invest all of your money in one stock, then you will only have standalone risk. And then if you say, no, I would like to follow the age-old dictum, that is, don't put all of your eggs in the same basket, then you say that, well, you are going to create a portfolio of stocks and look at the risk. Now, for this, if you see that how do you calculate the risk, you see there are two graphs here, one in blue, another in purple. And the one in farm X and the other is farm Y. Which do you think has got more risk? The average risk is, if you look at average risk, is 15, and then farm X has got a higher risk than farm Y because it is dispersed. Like you see here, if you look at this here, if the peak is higher for this one, and the peak is let me do this again. If you look at this carefully, and we are looking at zero risk and here, and then if this one is higher than this one, then you say this risk is lower, because risk is depicted in here. Right here, this is your risk, and this is your return. So in this case, Y has lower risk than X, and so we say that riskiness can be found out by the dispersion. This one, the purple one, is highly dispersed, and then this is peaked. When we calculate the standard deviation of small cap versus large cap, you can understand that small cap is more risky than the large cap. If you look at, on the other hand, portfolio, where equity is more, 90% is equity and 70% is equity and 30% bond for the other one, you can expect that portfolio risk is higher for the one that has got more stock. And so if you also go by the economy, that when is certain stock is going to be highly risky. So you can see probabilities are like recession happens only 10% of the time, and below average, above average, and boom happens only 10% of the time, and the average happens 40% of the time. So if you look at the T-bills first, you can see there is no variation across different stages of the economy. So you can call this risk-free. And on the other hand, if you look at various other sectors of the economy, you can see that this is high technology, and you can see that the boom time, this has got high return than the other ones. So different. Now we are in the COVID situation, and in this COVID situation, you can find out various sectors of the economy have been impacted differently. Like restaurant and retails are impacted negatively. So therefore, you can say that there is a decline in the rate of return expected. Now, when we go to that problem, that is how to calculate expected rate of return. So this is expected rate of return, right? Then we'll talk about required rate of return later when we talk about CAPM. So this is the equation, and this equation means that our expected is P1 R1 plus P2 R2, and then we go on to N equations, N securities, so which is Pn and Rn. So when you calculate this for expected return, like this is the recession is 10%, boom is 10%, and then the average is 4% probability. So we see that expected return is 9.9. And then, by the way, you are expected to calculate this expected return for your exam. Now, when you have expected return calculated this way, we for this one is 9.9. This is for high tech, and then we look at the market, rubber, bills, collections, and then we have expected return. So highest return, expected return is high tech, and you'll see why is that so, because it is higher risk. And risk can be, this is the risk, and risk can be calculated by standard deviations. And how do you do that? You take individual return and subtract from expected return, which we just calculated to be 9.9, and then square it and then multiply by PI probabilities. So this is the one. So you say for all individual one, 3 minus expected return of 3, this is for T-bills. You do all of those, you'll see that you get 0%. And if you do high tech, you will do 20%. I suggest that you do only for high tech and see whether you get to 20%. On your exam, if I give you to calculate standard deviation, it will not be more than 3 varieties. Like you see here, there are 5 varieties. This is one variety, this is second variety, third, fourth, and fifth. So I will give you at least 3 situations, like recession, average, and boom, that kind of stories. And so you see that high expected return of 9.9% is accounted for by the riskiness, that inherent riskiness for this situation. So you can see the one that we started the graph with, the purple and the gray, and then you see the one that is has high peak will be basically higher risk, and then T-bills is a straight line. That means there is only one risk in here. And then we see standard deviation is the measure of total risk. So this is the part. total or standalone risk. Please keep that in mind. So standard deviation is the total risk or standalone risk. Nothing is put alongside. So the larger sigma, that means higher is the expected return. Now, you can now check two things at the same time. Expected return for many are done here, and then risk is zero, and then all the things. So it looks like that. Which one do you think is out of place? So this has got higher risk, yet its expected return is lower. So it seems that this is not working. That claim that expected return is related to risk, but most of all of the other ones have supported that. This is another metric that you do, coefficient of variation, and variation is on top and expected return is in the denominator. So that is also another measure of risk, and we are not going to look and calculate coefficient of variations. That means we are not going to emphasize that, except for the fact that connotation is that higher the coefficient of variation per unit of expected return is going to indicate that this is more risky. So higher CV, higher is the risk. And then there is another one, Sharpe ratio, and this is an alternative measure of standalone risk. So what happens here is you look at the expected return, subtract from our risk-free, and divided by expected return. So Sharpe ratio is basically you look at the excess return. So it is that expected return minus risk-free, and then divided by the expected return. And that's Sharpe ratio. So higher the Sharpe ratio, higher is the risk. So this part is known as excess return, excess over risk-free. So with that thing, we can say that high-tech ratio has 0.345, the highest in here. And so we say that this is the one. Expected return is assets. Okay. A risk-free asset will be 0, Sharpe ratio. So now this part, that is excess return, is also risk premium, called excuse me. And so risk premium, this part, the excess return that we talk about, is also known as risk premium. So we say risk premium is the difference between return on risky asset and riskless asset, and it's you have to pay the investors to take that risk. And risk aversion will be, which is not included in here. There is no risk aversion in this Sharpe ratio. So we say that risk premium will be, they may not just demand excess return, they may demand more than excess return. But usually we consider the risk aversion of an investor as an average risk aversion. Therefore, we treat excess return as risk premium most of the time. So risk aversion that depends on person to person. So you may have high risk aversion, and then your friend may have low risk aversion. So your friend may take many risky projects, you may not take highly risky projects. So now we are going to show that, well, these are the ways we used to do risk analysis previously, we said that let us devise something better. And in order to devise something better, we will do two stock portfolio. And there are two stocks. One is this one, and then another is this one. This one, high tech, and this one is low risk. And we say that we are going to invest 50% in high tech and 50% in a low risk stock. And we see that their average is of the portfolio. This is the portfolio return. So you are responsible for also portfolio weighted average return. So this is your expected portfolio weighted average return. So, and similarly, you can do it in the variations of it. And we see that this is exactly same way we created the portfolio return of 5.5%. We are not going to do the standard deviations and coefficient of variations, but you see that by the way, there are negative correlations between stocks. What happens is that when some return goes down, the other return goes up. That means we say that they are negatively correlated. And so if you look at stock market, usually the risk is 35%. Now, if I take M and W stock, so this part, the blue part is M stock, and W part is the red one. So if you see that when this W goes down to less than maybe negative 10%, you see M stock, on the other hand, goes up even to close to 40%. So negative return from red stock is more than compensated by the positive return of the blue stock. And you see the average is a flat line, green line, WM portfolio. When you are having W and M in the same portfolio, your portfolio risk is WM, which is a flat line. That means it is risk-free, no fluctuations. So you can see this in this curve, that is, it is 15%. Remember that we had T-bill showing exactly that way, except that it is 50% in here, 50% in here, but T-bill was 3%. So you say you just created a risk-free portfolio. So this is risk-free portfolio, and T-bill was risk-free security. So risk-free portfolio. And this you could do because you understand that putting in a portfolio, you can basically reduce risk. So what should be your strategy in future? Should you take stock in isolation, or you keep it in a portfolio? So, and the theoretical analysis here shows you that, well, putting in a portfolio, you will reduce risk. All right, then I'm going to talk about this graph, and this graph is a very, very important graph for you because it shows you few things. One of them is what is the relevant risk. So we are going to find out what is relevant risk. You should be compensated for relevant risk. If a standalone risk is 35% and you demand that your expected return should be based on 35%, then you are making a wrong analysis. You say that, well, actually, as you build portfolio by diversifying your risk, you see that, well, that will reduce from 35%. So let's say I take one stock here, and I know that risk is 35%. As I add more and more stock this way, you see my risk is basically reducing. And at this point, which is generally 40 security, the risk is almost close to zero. So if you have a 40 stocks in your portfolio, you know your portfolio risk, not individual risk. Your portfolio risk is going to be at a basically becomes a flat line. If you have a 2000 plus stock, it is very much here, that is, it becomes 20.4. So you have reduced the risk of an individual asset or individual security, individual stock, from 35 to 20.4%. And this you could do only because that there is a diversifiable risk in here. So how much risk is diversified away? If you take 40 stock portfolio, about 15%. So now you are asking, what is the relevant risk? So you say, if you are on a 40 stock portfolio, you have diversified some risk totally. And what is the diversifiable risk? The shaded area. This is your diversifiable risk. So you have, depending on what is diversifiable risk, depending on number of stocks in a portfolio, you have you diversify more and more risk of this asset. And so I would like to bring your attention to this part, that is where you are holding just between 10 and 20 stocks. And this part, this part is diversifiable risk. And this part, let me get rid of that, and let me add things, letters here. Let's say this is A, this is B, and this is C. So AB is diversifiable risk, because it will not be there anymore after adding more and more stocks. Then BC is market risk, or call first non-diversifiable risk. And of course, AC is total risk. So out of, you need to be paid only for the relevant risk, and which is BC. So non-diversifiable risk is also known as market risk. That is, you cannot diversify away market risk. So what is then that we are looking for? How much should I be paid to hold this stock? What should be my return? You say it should be based on not total risk, not irrelevant risk, but on relevant risk, which is basically market risk. And this is the definition of diversifiable risk and market risk. So please take care of this closely. And then we say that now here is the thing which he has given us our first Nobel. That is, we say that when you are requiring any kind of risk, you say, I will require plus something. That means if I am taking some risk, I will require at least risk-free return and plus something. What is that plus something? That something is that assume that I'm looking at an average security which has got the same risk as my security is same as market risk. And so in that case, I will ask for RF, but I will say that it should be giving me risk premium of this much times we introduce something called beta. And beta is basically a parameter that will measure how it is related to the market. So if beta is 1, that means my security is as risky as the market. If I hold the entire Dow Jones, that will still be risky for me because the market falls. So if the market, if my security is the same as the market, that means beta is equal to 1. In that case, I will demand risk-free plus this risk premium. So this is risk premium for market. And then the whole thing, this much, is called risk premium for ith security. Okay? So the total thing is RM minus RF times beta is the risk premium for the ith security. So if it is like market, then it should be RM minus RF times 1. If it is more risky than market, then they will demand more risk premium. So this thing is called cap M. This equation is called cap M, capital asset pricing model. So let's see how it applies. And then we go, and now I'm going to give you a definition of beta. The beta is a relative and relevant risk. Relative to market and relevant because we took away the diversifiable risk of an individual security in a diversified portfolio. So if beta is equal to 1, the security is just as risky as the average stock. Greater than 1, it is riskier than average. And less than 1, it is less risky. And most betas range from 0.5 to 1.5. Some of them even have negative betas. It can happen. That means when market goes down, those securities goes up. And so that can happen. And it depends on the correlation of the securities. So the correlation, if the correlation between stock I and the stock market is negative, then beta can be negative. So, however, beta is highly unlikely. So, beta negative means it is not necessarily the let's say beta of 0.5 plus 0.5 and beta of negative 0.5. They are they have the same risk, but it only indicates the direction of the movement. So it is the quantity of beta, absolute level of beta, that says what is the risk level. And the directions are, the plus or minus are given that which directions this will go. So we are going to say, look here, this is the market. return, average market return, and this is the individual security in question. We look at this and in this line, and this line is known as characteristic line. Okay, so you can see the slopes is positive, so the beta should be positive. So when you find through regression that the beta, we see that this is the regression equation. And in this regression equation, this one is called beta. Same thing with others, and T-bill is a flat line, flat characteristic line, and this has the high tech is higher thing and collection is negative. So you can see now that as the market improves, collection is falling and so forth. So we know that if the market goes down right now, then collection would be rising. So with that scenario, we now look at SML. That means I'm going to now look at the graphical representation of CAPM is SML. So we now look at different levels. These are all required returns. When you apply CAPM, these are required returns as opposed to what we did before, which is okay, required return without the hat. But so far, when we looked at the existing knowledge, how to treat risk, we call them expected return because it was based on probability. And this one is required return. As an investor, you will require 9.55% for the risk that you're taking. And as an investor, when you do T-bill, you require 3%. Okay? Compare this with expected return calculations. And then what would be your relationship? This is the required rate of return is 9.55 and expected return is 9.99. This was done through our existing knowledge, and this is our new knowledge, right? This one is our new knowledge. So if you require less than expected, you say this is an undervalued security. If you require same as expected, then you say it's fair valued, and same way others follow. So collection is undervalued also. So now with that scenario, you can see in a graph. That means if this is your SML, and if you see that it is on the line, then it is on the fair valued. And these are the required rate, the RM, RF, these are the required rate of return. And if high tech is above that, then what do you say? That means you are looking at an undervalued security. You see? Anything above SML is undervalued securities. And if anything below SML is overvalued security. Do you think in the long run this undervalued and overvalued will exist? You say no. When somebody finds out that a high tech is an undervalued, they will go for it, prices will rise, and therefore high tech will move from above to the line below, to the SML. On the other hand, if there is US rubber and other securities that are below the line, people see this is overvalued, they will sell, and then the prices will fall, and then it moves up to SML. So in the long run, it is expected that all securities lie on the SML in the long run. But in the short run, there can be securities above SML and below SML. So with that scenario, we then look at a very, on your exam, you need to compute CAPM. You need to be able to also tell us that what happens, is this security undervalued or overvalued given the expected return. And then you need to say that what would be investors' reaction if it is undervalued, and what would be the investors' reactions if it is overvalued. And with that scenario, we move on to the last part here, that is CAPM, even though it's just one factor model. That means, why do I say it's a one factor model? You see here, this is only one factor. Beta is the only factor. So we call this one factor model. Yet, such a simple theory, that means it says that required return would be function of risk-free, risk premium, and beta. If you know these three factors, three returns, if you know the three returns, that means return for risk-free, risk premium, and in the risk premium again, return for the risk-free and the individual return. So if you know there are three returns in here, so three returns are RI, RF, and just give me a second. And RM. If you know these three returns, just having this factor beta, you will be able to figure out rest. So let's say I go to this, that a simple CAPM model, and we have one SML1, and assume there is an expected inflation. So what I'm trying to prove that CAPM is very strong. So if I ask you, if you believe that inflation is going to rise, what will happen to the required rate of return? Answer is required rate of return should rise. So let's see how it happens. With SML is, of course, RF, right, plus risk premium for the market times beta. Now, at different, all the betas are in x-axis. So what would be your return for this? You see, as your expected inflation goes up, your RF goes up, because RF has expected inflation in here. Therefore, your required rate of return goes up. And when your required rate of return goes up, this shifts. And once this shifts, then it is in here, SML2. So now you see, you look at an asset that has a beta of 1, and you used to require this much, now you are going to require higher return. So previously it was 8%, now it will be 11%. So that was a question I asked you. What do you think will happen to the required rate of return if inflation is expected to go up? So you say the required rate of return will rise, and that's what it is, from 8 to 11%. And then you have the other part. Again, the simple theory is explaining it. That was affecting, this affects the intercept from 3 to 6, because change in inflation is 3. So it goes from current level of 3 to 6%. But what happens, let's say right now, COVID situation, and then people get afraid. Right after COVID, when things were so uncertain, market started to tumble. And can you explain that? You say, yes, I can, because the risk aversion goes up. So if you look at, again, that is here the intercept is 3. It doesn't change. Risk aversion is the measure of risk aversion is this risk premium, the slope of the line. So is RM minus RF is risk aversion. So what is RM minus RF? That is the slope of SML. So when you are afraid to invest, it was right after COVID-19. So you see it moves up like this, slopes upward. So it slopes upward. And then again the same analysis, that is you are investing in a beta of 1 security and it moves up. That means previously it was 8% required, now it is 11% required. So what happens then? That people will demand more. And if you demand more, then your return will go up as well as your prices will go down. How do I know that I have more return? You say that, well, when you pay less price. So market falls very quickly. So the return goes up. So you see the RI goes up, and which means price of the stock will go down, because people will say, you cannot entice me to go into the market unless the price is right for me. So price will fall. Return and prices are inversely related. So with that thing, we see that even complicated process like expected inflation or risk aversion, we can explain it through CAPM. So now CAPM, finally we say, it has not been verified completely. People are still researching. One of the reasons is that statistical tests are not great. And then some argue that, well, CAPM is one factor model. We might want to get many other additional risk factors. Hope this is clear for you. If not, let me know, and then we go from there. But this is a very, very important chapter. That is what is the relationship between risk and return. Take care. Thank you.